Enron was not just a corporation. It was a promise that markets could be mastered through intelligence alone, detached from physical production, commodities, and limits. In the late 1990s, Enron was celebrated as proof that finance could replace industry and that risk could be engineered into innovation. Politicians listened, investors applauded, media echoed the story, but behind the polished earnings reports, complex derivatives, and aggressive confidence, a system was forming that generated appearances rather than value. When trust finally cracked, the collapse was sudden. Billions in market value vanished. Pensions evaporated. Careers ended. What remained was not just a bankruptcy, but the failure of a belief system. Enron's story reveals how power, incentives, and unchecked faith can construct institutions that appear stable until reality quietly removes the foundation beneath them. Enron was created in 1985 through the merger of two regional Texas energy companies. Its original business was straightforward: transporting and distributing natural gas. That changed under the leadership of Kenneth Lay and later Jeffrey Skilling. Enron no longer wanted to own pipelines or power plants. It wanted to own markets. Skilling, a former consultant at McKinsey and Company, reshaped the firm around financial engineering, aggressive growth, and constant reinvention. Internally, employees were ranked against each other, rewarded for risk-taking and punished for caution. Externally, Enron presented itself as a technology-driven innovator rather than an energy company. Analysts, banks, and regulators embraced the narrative. By the late 1990s, Enron ranked among the most valuable corporations in the United States. It symbolized a new economy where complexity signaled sophistication and accounting innovation was treated as vision. This transformation unfolded during an era of deregulation, cheap capital, and deep faith in market efficiency. Energy became a tradable abstraction, and Enron positioned itself at the center of that shift, well beyond the limits of its internal controls. Enron sold the idea that uncertainty itself could be turned into profit. The company claimed it had solved the problem of volatility by transforming energy into a financial product, tradable like stocks or bonds. Through long-term contracts, derivatives, and sophisticated models, Enron promised stability to producers and predictability to consumers. Risk, they argued, no longer needed to be feared. It could be priced, traded, and optimized. To investors, Enron offered something more powerful than earnings: inevitability. Management presented the company as a platform, not a utility. Energy was only the beginning. Bandwidth, water, weather, even pollution credits were framed as future markets Enron would dominate. Analysts were told traditional valuation methods no longer applied. What mattered was innovation, deal flow, and speed. This narrative was reinforced by reported profits that appeared consistent and growing, regardless of market conditions. The promise was simple and compelling. Enron had outgrown the limits of the old economy. It would extract value not by producing goods, but by intermediating reality itself. As long as markets existed, Enron claimed it would always be positioned to win. Enron's rise was rapid and expansive. By the late 1990s, the company had become one of the largest energy traders in the world, handling transactions worth billions of dollars each day. Its trading floors operated around the clock, mimicking the culture and intensity of Wall Street investment banks. Enron was no longer constrained by geography. Deals spanned continents, currencies, and regulatory environments. The company's reported revenues grew at extraordinary speed, driven largely by trading volume rather than underlying cash flow. Accounting rules allowed Enron to record the full value of long-term contracts up front, creating the appearance of steady profitability. These numbers fueled a rising stock price, which in turn strengthened Enron's political and financial influence. Banks competed to finance its deals. Credit rating agencies maintained strong ratings. Regulators, facing complex instruments they struggled to understand, deferred to the company's expertise. Enron executives gained direct access to policymakers and helped shape deregulation efforts in energy markets. Internally, success reinforced behavior. Employees were rewarded for closing deals, not for ensuring their long-term viability. Complexity became a feature, not a warning sign. As Enron expanded into new markets, its reputation insulated it from scrutiny. The company appeared too innovative, too connected, and too profitable to fail. Its growing scale masked the fragility beneath the surface. The system did not fail all at once. It deteriorated quietly through incentives that encouraged concealment rather than correction. Enron's core weakness was not market volatility, but accounting practices designed to hide it. Loss-making ventures were moved off the balance sheet into special-purpose entities, structures that allowed Enron to report profits while transferring risk elsewhere. In reality, much of that risk remained tied to Enron itself. These entities relied heavily on Enron's own stock as collateral. As long as the share price rose, the structure appeared stable. When it stopped rising, the system began to unwind. Small declines triggered obligations that Enron could not meet without exposing the losses it had hidden. At the same time, internal controls were ineffective. The company's culture discouraged dissent and rewarded short-term results. Executives who questioned deals were sidelined. Traders were incentivized to maximize reported earnings, not sustainable cash flow. The internal ranking system reinforced silence, as employees feared being labeled underperformers. External oversight also failed. Auditors approved aggressive accounting assumptions. Analysts relied on management guidance rather than transparent data. Rating agencies reacted slowly, constrained by complexity and conflicts of interest. Regulators lacked both the tools and the mandate to intervene decisively. What ultimately broke Enron was not a single bad investment, but a feedback loop. Accounting hid losses. Hidden losses required rising stock prices. Rising stock prices depended on continued confidence. When confidence faltered, the structure collapsed under its own weight. The system was internally coherent, but fundamentally detached from economic reality. The collapse unfolded with startling speed. In late 2001, questions about Enron's financial statements turned into doubt, and doubt quickly became panic. Analysts revised their outlooks. Credit agencies downgraded the company's debt. Trading partners demanded guarantees Enron could no longer provide. Liquidity, the lifeblood of its trading model, evaporated almost overnight. As the stock price fell, the hidden obligations embedded in Enron's off-balance sheet structures were triggered. What had been concealed through accounting complexity now surfaced in public view. Attempts to reassure investors only intensified scrutiny. Internal emails, delayed disclosures, and sudden executive resignations signaled deeper problems. Within weeks, Enron was unable to operate as a going concern. Employees watched retirement savings collapse alongside the share price. On December 2, 2001, Enron filed for bankruptcy protection. At the time, it was the largest corporate bankruptcy in U.S. history. The speed of the collapse shocked markets. A company once described as unstoppable had unraveled in less than a month, revealing how quickly confidence can reverse when trust is removed. The aftermath extended far beyond Enron itself. Thousands of employees lost their jobs and pensions. Shareholders absorbed billions in losses. Investigations exposed systemic failures in auditing, regulation, and corporate governance. Several executives faced criminal charges, while others avoided accountability altogether. The scandal led to the dissolution of Arthur Andersen, once one of the world's largest accounting firms, and accelerated regulatory reform through the Sarbanes-Oxley Act. Transparency and internal controls became central concerns in corporate reporting, yet many of the underlying dynamics remained intact. Financial innovation continued. Complexity persisted. The lesson appeared to be learned in form, but not fully in substance. Enron became a reference point, not a stopping point. Enron did not collapse because markets failed to work. It collapsed because markets were asked to believe what could not be verified. Complexity replaced clarity. Reputation substituted for evidence. Confidence became a resource that was consumed faster than it could be rebuilt. The story is not about fraud alone, but about systems that reward appearances over resilience. When incentives favor short-term performance and punish transparency, instability becomes rational behavior. Enron's rise and fall illustrate how modern power often rests on abstraction and how fragile that power becomes when disconnected from reality. The collapse was sudden, but the conditions for it were built patiently over years in plain sight.